All right, folks, welcome back. This is Professor B. I wanted to talk about intercompany transactions, specifically intercompany sale of depreciable assets in Chapter 4, because we didn't spend enough time on it, I think. In Exercise 4, we have a transaction on Jan 1, 2016, where Jungle Company sells a machine to Safari Company for $30,000. The machine had an original cost of $24,000 and an accumulated depreciation on the asset was $9,000 at the time of sale. What this really means is that the book value, which is equal to cost minus accumulated depreciation, is equal to $15,000, which is $24,000 minus $9,000. So we had a machine with a book value of $15,000 and it was sold for $30,000 within the affiliated group. And so right off the bat, we can see that there is a gain of $15,000 that the seller recorded and the buyer paid. However, because this is an intercompany transaction and in consolidations, we typically do not allow intercompany gains or appreciation of assets to be made. This $15,000 right off the bat must be eliminated. And so I'll go ahead and debit and credit $15,000 respectively, which of course reduces my machine's value to its original book value of $15,000, and simultaneously I go ahead and eliminate the gain on the sale of machinery between the affiliated members, because that is not to be recognized on consolidated statements. And so typically if you want to disallow a gain, which is typically a credit, you need to issue a debit to this. This also means that this additional value that was recorded by either of the affiliates individually yielded a higher depreciation than what should have occurred for the consolidated group. In other words, when the buyer purchases machinery, they bought it for $30,000 and they would have gone ahead and depreciated that on a straight line basis for 5 years. That would have been $6,000 a year. However, the initial book value, or the book value to the consolidated group, is of course $15,000, and the correct depreciation for the consolidated group should have been $15,000 divided by 5, which is of course $3,000. In other words, $6,000 worth of depreciation was taken by the buyer on an individual basis, but for consolidation purposes we should have recorded a depreciation expense of $3,000, whereas a $6,000 depreciation expense was recorded by the buyer. So what we typically do is we reduce the excess depreciation in the F2 entry by removing the excess accumulated depreciation and reducing the depreciation expense that was incorrectly taken, in this case $6,000 minus $3,000, or exactly $3,000. So what is the net impact of all of this? The net impact is that when you consolidate all of the assets and liabilities together, along with all of your revenues and expenses for the consolidated group, you're going to have a value of machine at $30,000 recorded by the buyer. And then you're going to see it reduced by $15,000 because of this credit here. And any gain will also be eliminated, which would have been prior in the past recorded by the seller. So when you combine the buyer and seller's separate income statements or balance sheets, or what we do through the worksheet, both of those items, you would see no gain on this intercompany sale, and you would see the value of machinery drop again from $30,000 to $15,000. You would also see the correct depreciation expense amount of $3,000, which would have been previously recorded as $6,000, but now that we issued a credit of $3,000 to depreciation expense, you would see that come down as well. So this for the year 2016, ensures that we have the correct value to the consolidated group on the asset, on the depreciable asset, and the correct depreciation expense on the same depreciable asset. Let's move on to 2017. In 2017, we again need to recognize that the consolidated entries were done on a provisional basis and not really recorded by either of the affiliates. So then we go back to the value of machinery at 30,000, and again we need to bring it back down to what it was to the consolidated group before the intercompany transaction occurred. So again, we're going to want to reduce the value of the machinery by the $15,000 that was inherent in that machine, which again should be a credit here to machinery for 15,000. And again, we're going to reduce the gain that was previously recorded by one of the affiliates, the seller, by 15,000 because we recognize that they're both members of a consolidated group and the gain really shouldn't have existed. Now, I know your template doesn't look like this. I know you just see 3 items here on your template, but it'll all make sense in just a few minutes. And you'll see why I had to add an extra line here. I wanted to explain something to you. Okay, so just stay with me on this for now. So we have gone ahead and fixed that gain and that excess valuation in machinery. The other part of the F1 entry in subsequent years acknowledges that in prior years, specifically 2016, excess depreciation was taken. So again, I can undo that excess depreciation, which was again $3,000, and record that as a debit to depreciation expense. And I can go ahead and remove also the depreciation expense specifically by crediting depreciation expense, except this depreciation expense theoretically belonged to 2016, which of course was a temporary account because all expenses are temporary accounts and would have closed out to retained earnings. So what I typically do is instead of crediting depreciation expense, I just go ahead and credit retained earnings for that amount. And so when this occurs, you'll note that there is a debit being made to retained earnings for 15 and credit being made to retained earnings for 3,000. So we typically just go ahead and net those 2 items. And of course, the debits win because we have more debits. And of course, 15,000 minus 3,000 is 12,000. This is what you're going to see on your end, and you're not going to have this extra box to jot all this down. But I wanted to have this here so that you could understand what the total impact was for these 2 items. I also want to mention that Jungle is actually the parent company, right? Safari is owned by Jungle, so the portion here, the seller, right? It was sold by Jungle, so the seller was the parent, and the seller gets to get their retained earnings reduced. However, if the seller was a subsidiary, which in this case is Safari, then you would have had to do some sort of a split here and then a split here. But again, we didn't have that situation where the seller was subsidiary. We had a situation where the seller was a parent company, so they get to absorb all of this reduction to retained earnings. Just wanted to real quickly also comment on this 15,000 here, which was a reduction to retained earnings. This was actually a gain from previous years. Remember, the seller would have recorded a gain of $15,000, and so we want to eliminate that gain. And typical way we do that is to record a debit to gain. However, because the gain was a temporary account and it's no longer there, and it increased retained earnings, we just go ahead and simply reduce retained earnings instead of reducing gains, because ultimately they're both connected and one impacts the other. So instead of reducing gain, here we're going to go ahead and just reduce retained earnings for Jungle. The F2 entry in 2017 then pertains to the current year depreciation excess that needs to be removed. And of course, again, we're going to want to reduce accumulated depreciation and credit depreciation expense to undo the current year stuff. So because F2 pertains to the current year depreciation in excess that was taken. And so again, the amount we already know is 3,000. But it was important for us to recognize that, hey, we took too much depreciation as far as the consolidated group is concerned, so I need to reduce that amount and I need to reduce the accumulated depreciation. So this particular bit took care of 2016's excess depreciation. This particular bit in F2 pertained to 2017's excess depreciation, and the remaining portions ensured that the machine was brought back down to its original book value, which was the book value for the consolidated group. Again, this was not the most difficult problem, but I kind of wanted to make sure you had all of the information that I could possibly give you on it. And there are some portions of this question that ask us to kind of discuss what needs to occur. So hopefully after having gone through this exercise, you'd be able to answer this question really well and kind of just narrate the steps you're going to take in this section. Again, you're going to go ahead and delete all of this and just kind of summarize or conclude with what you've done and what you've learned in this section. I hope this was helpful. There's, of course, if you have any questions, please reach back out to me. Thank you.